Hello, everyone. Luke Gromen, FFTT. Hope everybody is well. Had a great weekend. Pretty nice weekend weather-wise here, so hope everyone had similar wherever you are. Before we jump in here, just wanted to highlight a quick feedback we got on tree rings from the weekend. Luke just finished this week's report. Incredible as always. Geopolitical reference and analogy to the Syriana movie scene was so perfect. Couldn't be better. Thank you for your insights. So now we're going to jump right into the thoughts here, or the comments, if you will, from Raul. Hi, Luke. What do you think of fiscal stimulus just passed? Will it lead to higher yields, more borrowing, which can eventually lead to a higher dollar, or will it trigger another sell-off in the dollar? I think what they are doing is running the playbook from the August 2019 white paper written by former Fed Vice Chair Stan Fischer and former Swiss National Bank President Philip Hildebrand and Bank of Canada Governor Jean Boivin. It was a BlackRock Investment Institute white paper, and they said in the next crisis, we're out of ammo, we're going to have to go direct, and what go direct means is we're going to have a bunch of fiscal spending, and central banks are effectively going to cap yields to make sure there's no rise in yields that offsets the stimulative impact of the fiscal spending. And so we are seeing them run that playbook. And yes, I do think we'll see higher yields. I think we're probably starting to get closer to the point where they'll have to cap it. And I think the most important thing to pay attention to here is policymakers talking about keeping R below G, keeping small r below capital G. Small r is the nominal interest rate that the U.S. government has to pay. Other sovereigns as well. And capital G is the nominal year-over-year growth rate in GDP. And so you've seen this steady growing parade of policymakers, economists and policymakers, really since November in particular, where Jason Furman and Larry Summers put together a paper. They did a Zoom call with Ben Bernanke and Olivier Blanchard and Ken Rogoff. But the bottom line is there's some pretty heavy hitters, a lot of gravitas, former government connections. The gist of the whole paper was as long as we keep R below G, then there's no theoretical limit to what we can borrow. The debt position will be sustainable. The U.S. government debt can grow to infinity as long as R is below G. And so when you start hearing, when you realize they need to keep R below G, then you start listening to things that people like Yellen and Powell say through that keep R below G framework. I think you can start to see a lot more hints that that's how they're thinking. So to the next question from Knox and also from Joe, thoughts on the SLR, Operation Twist, and yield curve control going forward. The SLR is a supplementary leverage ratio for banks. There was an exemption as it relates to treasuries implemented last April that is set to expire on March 31st. Effectively, this amounted to recruiting the U.S. banking system into helping the U.S. Fed finance U.S. government deficits last year. And we're coming up on the 31st of March. This is creating some uncertainty around the treasury market and as a result around rates, because if this exemption is not extended, it's likely, it's possible, if not likely, that you'll see banks turn into sellers of treasuries alongside with a lot of other people these days. So my bet is that, or my belief is that we will see the SLR exemption on treasuries extended, at least for 3 months. I think they're very reticent. I think they're at least aware of the moral hazard that they will be implementing if they extend it for another full year. I think if they're not going to extend it, this is the only time they cannot extend it, because by this time next year, they're going to have all the same problems except bigger. And so it gets harder with each passing year not to keep extending it. So maybe they extend it for 3 or 6 months just to see if they can get out of it at that point. But I do think they'll extend it, especially given what we've seen in treasury markets recently. Yield curve control, I think in this case is almost a form of, Operation Twist, I think is almost a form of yield curve control at this point. I do think they would do twist before yield curve control, particularly given the negative rates at the short end as a result of some technicalities of the Treasury General account spending itself down over the next several months. So there's too much cash chasing too few short-term bonds, and you've got a long end that's maybe a little rising a little more aggressively than they'd like. So Operation Twist sort of fixes both of those, or helps them fix both of those. Ultimately, I think yield curve control is the absolute last resort, and I think they really don't want to get to that. I think they're eventually going to have to, but it's opening a Pandora's box for the Fed, and I think it's, to oversimplify it, people say, well, Japan did it and it was no problem. It didn't spur inflation. And Japan's a very different animal. Japan is a current account surplus. They have a massive net international investment position to the positive. They're internally funded. And the U.S. is 180 degrees opposite on every single one of those metrics. And so, and in addition, there is no massive euro-yen market like there is a euro-dollar market. And so basically, to me, I think it'd be very hard for the Fed to be conducting yield curve control in the Treasury market and not have that cause spreads to begin to widen potentially sharply in the global euro-dollar market. So in global dollar debt markets around the world. And so you could quickly see the Fed having to go from yield curve control in treasuries to mortgage backs to corporates to overseas dollar-denominated debt. It's a very slippery slope, and so I think they are going to try to avoid it as long as they can, but I don't think they'll be able to ultimately. And to me, ultimately, that means people thinking the Fed's balance sheet could rise linearly. I think at some point in the next 12 to 18 months, we're going to see a nonlinear rise in all possibility, if not likelihood. Next question is from Jen. Thanks, Luke. What do you think of this tweet? And it's from Haas. If the Federal Reserve is smart, and I think they are, they will let the market crash. People will flee into the U.S. dollar and bonds. 10-year would go down to 0 to 0.3%. This will give them more ammo to print more money. They did this in 2008. I think it's a valid playbook. The one thing I would say in terms of commenting on it is that things are very different today than they were in 2008. So U.S. debt to GDP in 2008 was about 60%. Today it's 130%. The entitlement programs in 2008 were all cash flow positive. In other words, there were more entitlement tax receipts than there were disbursements. That's now backwards. That started in 2011. The U.S. net international investment position was negative 8% of GDP in 08. Today it's negative 65% of GDP. And so, and then lastly, and maybe most importantly, U.S. true interest expense, the pay-as-you-go portion of entitlements plus Treasury spending, is 110% of tax receipts, and those tax receipts are more dependent on stock prices rising than ever, given what a big multiple of U.S. GDP, U.S. equity market cap is. And so my thought is that the U.S. just stood aside and let if the Fed just stood aside and let the market crash, we'd likely see before very long what we saw on March 20, which is at first you have the dollar up and Treasury yields down. And then, before very long, Treasury yields would start spiking. The Treasury market would crash right alongside the stock market, followed shortly thereafter by U.S. tax receipts as rising interest rates choked off the U.S. economy in the midst of a deflationary impulse. And so I agree it would send the dollar to the moon, but if they stood aside for too long, it would be shotguns and K-rations time, because you would see problems in the Treasury market, problems corporate market, mortgage market, significantly rising rates in the midst of a stock market crash. And that's just not something we have seen. And that's a function of those data I started this reply with, which is it's very different now than it was in 08. So I'll leave it at that answer at that. From CS, Mike Green recently hinted that Bitcoin's Achilles heel is that it is seen as a national security risk. Do you know what he means? I think I do. I mean, I can't, based on his public commentary, things I've read, so I can't profess to know what he's thinking specifically on that, but based on his public commentary, I think what he is saying is number one, it's a source of dollars for China. So to the extent that cutting off dollar flows to China, can be seen as weaponizing the dollar against China. China mines, in theory, around 2/3 of the Bitcoin, plus or minus. And so that's dollars into China, Bitcoin out. And so that helps China's dollar position. I also think over time, particularly the bigger it gets, Bitcoin threatens the dollar hegemony, threatens the Treasury market. And so to me, I think there is a big chunk of Washington that looks at Bitcoin that way. I disagree. I think there are also there's a growing part of the of Washington and the establishment that is seeing dollar hegemony as structured post 71 as a big national security threat. And I've gotten into this in some recent appearances, but just consider, since China went into the WTO in 2001, who's done better on a relative basis? Whose economy, China or the U.S.? Whose military has grown in terms of relative size, relative power more, China or the U.S.? Whose global geopolitical clout has grown and economic clout has grown more, U.S. or China, since China went in? And so really since '01, since China went into the WTO, the big winners have been China and certain Washington, D.C. interests. And I think there's a growing realization that this dollar system as structured that Bitcoin threatens in some way at some point that Mike is referring to, maybe something that forces a change of that system isn't such a bad thing. And I think there are interests in Washington and in the national security establishment that I think that way. So let's watch and see what happens. From Sebastian, thoughts on gold, the miners, and the commodities more broadly, both absolute and versus equity. I continue to like gold and gold miners. I continue to like commodities. Near term, I suspect that gold and gold miners may continue to underperform on a relative basis in particular as nominal rates rise. And I think virtually everybody's running certainly consensus. I won't say virtually everybody, but consensus is clearly running a post-war recovery playbook that suggests you don't own gold here. And I think commodities probably keep outperforming in that regime. With that said, I think it's critical to understand, particularly vis-a-vis gold and gold miners, that we are not this is not a typical post-war recovery. There is no other post-war recovery on record where we're starting at a debt to GDP of 130%. There is no other post-war recovery where foreign central banks have not added to their holdings of treasuries in 7 years. There are no other post-war recoveries where U.S. true interest expense is over 100% of tax receipts. And so when you factor all these things in, to me, it suggests that while painful in the short run, that gold miners have had a painful start to the year, I just don't lose a lot of sleep over, because the pairing of yield curve control and stimulus that we talked about before is likely coming. It's likely coming soon. Every tick higher in the 10-year is that much sooner that yield curve control and stimulus combined is going to have to come. And they're really just trying to get increasingly negative real rates is what that's saying. So, and that will be very good for gold and gold miners in my view. So that's really what we're watching for as a catalyst for those two. I would say also multi-currency oil and commodities means that we need a weaker dollar to have continued commodity strength, in my opinion. So I think dollar strength would be the only thing that cuts off the commodity bull market at this point. And then finally from Michael, is digital gold and virtual real estate the same? In my opinion, no. Gold and digital gold, or Bitcoin is how I look at it as digital gold, both require significant energy inputs to create. Virtual real estate does not, and it's the same as virtual gold and fiat currencies, actually, for that matter, too. They all require insignificant amounts of energy to create. It's a couple keystrokes. You go there on your computer, click, 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 there we go. So in my opinion, a bigger picture, a key to investing in coming years is going to be own what's more finite. And you can see Michael Saylor, the macro strategy Bitcoin playbook, where he borrows dollars and buys Bitcoin with it. That's just a small, concentrated niche version of what China's been doing for over a decade, which is here. You take the dollars, we'll borrow the dollars, or we'll spend our excess dollars, and we're going to buy ports, oil fields, copper mines, gold mines, etc. Finite hard assets, oftentimes stuff that hurts when you drop it on your foot, but not always. Some of it can be intellectual property, etc. So I continue to think that's the way you have to play this cycle, given the things we talked about before with a unique, atypical starting point for recovery. And given what we think is the first bursting global sovereign debt bubble in 100 years. And so with that, we're going to finish up for the night. Again, if you're interested in following up, learning more about tree rings, check out the link. There's more information there. And as always, everybody have a great week. Look forward to talking with you all soon. And be safe out there. Take care, everybody.